Welcome to The Explainer. Today, we're jumping into one of the most incredible stories in modern finance. It's a tale of a massive collapse and an almost unbelievable recovery. We're going to peel back the layers and uncover the actual blueprint for how a financial giant can be brought back from the absolute brink. To really get a sense of how bad things got, just look at these numbers. In September 2018, one share of Yes Bank cost you 400 rupees. Fast forward just 18 months, and that same share was worth 5 rupees. That is a mind-blowing 98.7% wipeout. For all intents and purposes, this thing was dead in the water. And, that massive crash brings up this central mystery we're really digging into today. How does an institution that big, that connected, possibly pull itself out of a nosedive like that? Well, as you're about to see, this isn't some story about a miracle. It's a story about a very specific, high-pressure process.
Okay, let's get into it. To understand the comeback, we first have to really understand the collapse. So what exactly pushed what was India's fourth largest private bank right to the edge of disappearing completely? Well, it really kicked off with a huge leadership change in late 2018, and that one event pulled back the curtain, revealing some really serious problems with their loans. Throughout 2019, the whole situation just spiraled. Confidence completely vanished, cash started drying up, and big questions about how the bank was being run started popping up. By March 2020, the regulator, the RBI, had no choice. They had to step in and freeze everything just to stop a total meltdown. So the bank is basically on life support. And the question becomes, now what? And that brings us to the rescue itself. This wasn't just one single action, but a really coordinated strategy, and it was built on 4 absolutely critical pillars. The solution wasn't some kind of silver bullet. A better way to think about it is like 4 essential ingredients, and each one was just as important as the next. You had the regulators giving their backing, a complete overhaul of the management team, a massive injection of cash, and a brand new business strategy. The key thing here is the balance. If you took away even one of these, the whole rescue probably would have fallen apart. And here's exactly how those pillars were put into action. First, the Reserve Bank of India came out with an official reconstruction plan. That sent a powerful message. This bank will not be allowed to fail. Then, they brought in a new, credible CEO who had experience with these kinds of turnarounds. Next, a group of banks, led by the State Bank of India, pumped in 10,000 crore rupees. We're talking well over $1 billion to make sure the bank was stable. And finally, the bank's whole mission changed. It moved away from making these huge, risky corporate loans and pivoted to a much safer focus on lending to everyday people and small businesses. Now, this is where the story gets way bigger than just one bank. While the Yes Bank situation was super dramatic, the pattern of its recovery is actually something we see over and over. It gives us a predictable framework that we can use to understand almost any major financial turnaround, and it all builds into a 4-phase model. Think of it like treating a patient in the emergency room. Phase 1 is crisis and stabilization. You gotta stop the bleeding. Phase 2 is about stabilizing the patient's vitals, or, in this case, the bank's loan book. Phase 3 is rehabilitation, getting the bank back to making a profit. And Phase 4? Well, that's when the patient is finally healthy enough to get up and start running again, getting back to growth and winning back the market's trust. And right here, we can see how those phases translate into actual hard numbers. Let's break this down real quick. Gross NPA ratio is just a fancy way of saying the percentage of loans that have gone bad. You can see it starts sky high in the crisis and then steadily drops. Credit cost, that's the money the bank has to set aside to cover those bad loans. It's high at first, but then it falls as things get better. And finally, ROA, or return on assets. That's a key way to measure if a bank is actually profitable. It starts in the negative, the bank's losing money, but by year 3, it's back in the black and on its way to looking like a healthy, growing bank again. Okay, so we have the blueprint, but how do you actually apply it in the real world? How do you, just by watching, figure out if a comeback is really on track? Let's pull back the curtain a bit and look at the kind of scorecard that the pros use to analyze these high-risk, high-reward situations. When an analyst is looking at a turnaround, not everything is created equal. The single biggest question, the one that carries a full 25% of the score, is all about asset quality. Are the bad loans actually getting cleaned up? And right behind that are 2 other huge factors. Is the new management team believable, and does the bank have enough cash? If you get those 3 things right, you've pretty much covered most of the analysis.
This matrix is how you turn all that thinking into an actual decision. You literally go line by line. For asset quality, are the non-performing assets, the NPAs, clearly going down? Great, that gets a strong score, maybe a 9 out of 10. For management, is the new leader a proven turnaround artist? Awesome, that's another high score. But maybe capital adequacy is just adequate, not strong, so that gets a medium score, like a 6. You just multiply each score by its weight, add it all up, and you get a final number that helps you decide, is this a buy, a watch, or a hard avoid? Now, this all might sound very scientific, very neat, but I really have to stress this. Betting on a turnaround is one of the riskiest games in all of finance. The blueprint is a great guide, but it is not a guarantee. There are some really unique dangers here. A bank, at its core, runs on confidence, and that can disappear literally overnight. Regulators can change the rules without warning. You might discover even more bad loans hiding on the books. And maybe the recovery needs more cash, which waters down the value of existing shares, or it could just take years longer than anyone hoped. Any one of these things can completely derail the comeback story. Which brings us to the ultimate question, right? We've seen the anatomy of the collapse, we've laid out the blueprint for the recovery, we know the potential rewards can be huge, but we also know the risks are very, very real. So, armed with this framework, knowing what you know now, would you bet on a comeback? That's definitely something to think about.